The LIFO retail methods. These methods we still apply retail methods, but we integrate the cost flow assumption LIFO, last in, first out, that were introduced in the prior chapter. What's last in, first out? So the newer inventory that were purchased will be considered firstly sold or out. Just think, if there's a net increase in the inventory quantity, that also implies the quantity of purchase is greater than the quantity of sales. So the ending balance inventory will be added by another layer of the purchase, while the beginning inventory stays. When the quantity of sales is greater than the quantity of purchase, there will be a LIFO liquidation. The old layers of inventory will be sold or liquid. To be more realistic, let me show you the example how LIFO works. Again, we use the same example. Here we have the beginning balance inventory at cost and retail value, purchase cost and retail value. We include both net markup and markdown. Then this is the cost of purchase. Also, goods available for sale excluding beginning inventory at cost. Since it is LIFO, last in, first out, the markup and markdown only apply to the purchased inventory, not older inventory. Goods available for sale excluding beginning inventory at retail value is $472,000. And the sum of these two is goods available for sale including beginning inventory. At the cost value, this is retail value. We actually have two cost retail percentage of ratios. One is we use the beginning balance of inventory cost divided by the retail value of the beginning balance of inventory, 62%. The next is we use the goods available for sale excluding beginning inventory to determine another cost retail percentage. Why we need these two ratios? If the inventories that are sold only apply to the inventory from the purchase, we only use this ratio. If the quantity of sales is greater than the quantity of purchase, sum of the sales will apply this ratio, because the beginning inventory is considered sold. In this example, the total sales was $434,000. After we subtract from goods available for sale at retail value, we have the retail value of ending balance of inventory. What we find is it is greater than the beginning balance of inventory. The difference is $38,000. That means the $38,000 that inventory was now sold is from the purchase. So to determine the cost of this inventory, we apply these two different ratios. First, 160 is beginning balance of inventory, so we apply 62%. Because remember, this ratio is determined by the cost of beginning inventory and retail value of beginning inventory. 38,000 was from the purchase. So that's why we have another ratio, which is determined by the cost of purchase and retail value of purchase after including net markups and net markdown. And finally, we have the cost of each layer. The sum of them is cost of ending balance of inventory. If we subtract this number here from goods available for sale at cost, this is the cost of goods sold. There are also other elements or factors in the real world we should consider, and they will have impact on the cost to retail percentage. For example, the freight in, this is only have impact on the cost. So this information is only an input in the cost column. Purchase return, it has impact on both cost and retail. When the purchase are returned, both cost and retail value decrease. Purchase discount only deducted from cost amount because it have impact on the cost of purchase. So this is discount from the supplier. And abnormal shortage, it is deducted from both cost and retail amount. So the factors above we should integrate in the calculation of cost to retail percentage. Since the cost and the retail percentage has been determined, so the next two factors will only have impact on the retail value column. So we are asked to use conventional retail methods. Conventional methods, we only include markup. We only include net markups. We exclude net markdown to determine the cost to retail ratio. So ratio 70% is determined by the beginning balance at cost, purchase at cost, so that's goods available for sale at cost, divided by beginning balance of inventory at retail, purchase at retail, and only add net markup, no markdown. Finally, when we determine the inventory balance, these four are goods available for sale, including both net markups and net markdowns. We subtract the sales, then the difference is the retail value of inventory in the end. We multiply it by 70%. This is the estimate cost of inventory at the end of the year.